Hi, welcome to Finance 367's pre-lecture video on introductions to options. My name is Professor Kevin Ewan, and in this lecture series, I'll be talking and giving you an overview of options and how they're used and the different types of payoffs associated with calls and put options. So let's go ahead and get started. Now, to begin talking about options, we obviously need to define what an option is. And an option contract gives the holder the right, but not the obligation to buy or sell a particular asset at a specific price at a specific time. In other words, it gives them the option to do what they want. Now, like all things in life, there is nothing for free. And in return for this right, the buyer of an option pays the seller of this option a premium, and this is associated with the cost of this product. And believe it or not, the hardest part about options is to first get the terminology straight. And the two options we're going to be talking about in this lecture are call options, which I'll give the buyer the right, which gives the holder of the option the right to buy the asset at a particular price, and a put option, which gives the right of the holder to sell the asset at a particular price. Now, once we understand what a call and put option is, solving problems and understanding payoffs really comes down to taking a step back and asking ourselves what an option gives the holder the right to do. And an option contract is going to specify, first of all, the strike price. Let's denote that as X. And this is the price that they agree upon a call, for example, in a call option, what they can buy it for, or in a put option, what the holder can sell it for. And another aspect of an option contract is the maturity date in which the option expires. Now, there's a couple of features of options that I want to talk about, but the most important one is I would consider is leverage. Okay, so when you're deciding to be exposed to a particular asset class, you can either buy the stock directly and be exposed both. If the stock goes up, you enjoy the gains, or if the stock goes down, you face the losses. Or you can also buy an option to have exposure. So the reason why an option is valuable for investors is by paying only a small premium, let's say, for example, $2, investors can now have a large exposure to a particular asset's movement, right? So we'll go through an example of what we mean by that. But rather than buying Amazon or Google stock directly, you can buy an option for that and have the opportunity to buy it at a particular strike price. Again, this is going to make much more sense when we actually do a numerical example, but this is something that I want you to keep in the back of your head as we're going through this video. And as a result of options as a result of call and put options having different types of payoffs, they can also be constructed and purchased in specific different ways to have different kinds of payoffs. So what I mean by that is, for example, what if you want to have a payoff that looks something like that, right? In other words, if we have over here the stock price, and over here the payoff, well, with options, you can create arbitrary and a little bit more complicated payoff structures by mixing and matching call and put options. And that's something that we'll talk about in class as well. And another feature that's useful of options is speculation. Because as I mentioned, when you're buying a call option, you're given the opportunity to buy a particular stock or asset at a predetermined price. So by taking on and buying these options, you're essentially taking on a bet of the stock going up and buying it at a cheaper discount. And also risk management. So in other words, for example, a put option lets you sell a particular stock at a particular price. And let's say you're very afraid of the stock price dipping below, let's say, $50. Well, you can buy a put option, and that gives you the right to, at any point, sell the stock at $50. So that's also a good risk management tool and would help protect against downside risk. And that's something we'll also talk about in this lecture. And it's also worth noting that there's two types of options. There's European options that can only be exercised at the expiration date. And what we mean by exercised is executing the option. In other words, using it when it makes sense. So if the stock price is, let's say, I don't know, 50 and the strike price is 45 and you have a call option, well, this makes sense because you can buy it at 45 when the stock is 50. And we usually call this in the money. Okay, so that's what we mean by exercising an option. It's choosing to buy it at a particular strike price in the case of call options and selling it at a particular strike price in the case for put options. And American options can be exercised at any time prior to the expiration. So as we mentioned before, option contracts have an associated expiration date to it, and an American option can be exercised anytime prior to that. So again, it's important to have the notation down. So in this lecture, we'll denote S as the price of the underlying stock. This is the price that you would look up in, let's say, Yahoo Finance or in any ticker program. The call price is the price that you would pay for the call option. As I mentioned, there is no free lunch. So if you want the option to buy a stock, you're going to have to pay the call price. The put price is the price of the put option. It's the price you pay to have the ability to sell a stock at a particular price. The strike price, again, is what both parties agree upon of dealing with the option, right? So in the case prior, the strike price was 45, and strike prices are always going to be listed in the option contract as well. And we just mentioned as well that there's a maturity date associated with each option contract. Now, let's talk about the value of options, right? So suppose you buy an option with a strike price of X. Well, what happens if the price of the underlying asset increases? Well, it's going to depend, right? Whether or not you have a call option. And if you bought a call option, believe it or not, the value of the option increases. And why might that be the case? Well, the intuition, again, for the call option is you're locking in a particular price. So let's say you're locking in a strike price of 30, okay? And the stock price is, let's say, 40. And it keeps increasing to 60. Well, now the value of that call option is going to be much higher because you're always going to have the option to buy it at 30. So the higher the stock price of this particular asset, the more valuable it's going to be because you're getting a better deal. So the value of the call option is going to increase. Now, what about for a put option? Well, let's go again at a strike price of 30. At a strike price of 30 for a put option, that gives you the ability to sell it at $30. Well, what happens when the stock keeps going up to 40 to 60 to 70? Are you going to exercise this option? Well, of course not, right? You'd rather sell it out in the open market and get a higher price rather than the strike price. So as a result, the value of the put option decreases when the price of the underlying asset increases, because you can always go out into the market and get a better deal by selling it at a higher price versus exercising the put option. And let's take an example of a screenshot of an Apple options. Okay, so what we're doing is we're looking at a snapshot on October 30th, 2020, and we're looking at options that expire on November 13th, 2020. So about a little bit less than a month out, like about 2 weeks out. And if we'll notice, this is where the strike prices are listed. Okay, so 106, 107, 108, etc. The current price of the Apple stock is given by this number, 109.46. This is constantly changing in real time like any other stock price. And what we can see is at a strike price of 106, this is a great deal, right? Because you can buy it at 106 when the price is worth 109. So you'll notice on the call option sides, these numbers over here are all shaded in blue because, again, they're in the money because you can buy it for this price, right? You can buy it at this predetermined strike price when the current stock price is 109.46. So these are all relatively good deals. Now, on the other side, the put option, if the strike price is 110, 111, 112, that means you can sell it at these. You have the right to sell it at these particular prices. So these options are also going to be in the money. Okay, and that's why these are shaded in blue. And associated with this is the price of the call option, right? How much you'd have to pay for this right? And this is the price of the put option. Again, the put price that you would have to pay for this opportunity. So when you're looking at options contracts, you're typically going to see a column associated with the strike price. And the important thing to do is compare it with what the current stock price is to get an idea of where in the money lies. For the call option, it lies over here. For the put option, it lies over there. So I think it's worth going through an example of a call option. So let's say we have a stock stock XYZ, right? Let that be any stock you can think of. Let's say it expires, I don't know, December 2022, right? It has an exercise or strike price of $25, right? And the call option is on sale in November 2022 for $1. Okay, so that's the price you have to pay for an opportunity to buy the stock at $25. Now, the question is, what is the types of payoffs that we can face? Well, the answer to that is it depends on what the stock price is, right? So what this means is you pay $1 for the right to buy it at 25. So let's say if the price is the stock price, sorry for the notation. If the stock price at a particular point is, I don't know, let's say $28, what would your profit be for if you exercise this? First of all, would you even exercise this call option? And the answer is yes, right? Because you can buy it at a better deal for $25, and even when the stock price is $28. So your profit would be $28 minus $25. And what else do you have to do? Well, you paid $1 for it, right? So minus $1. So it'd be 3 minus 1, so that's a $2 profit. Okay, they often denote this, you'll probably see this in the book, as the options payoff. But if you want the total profit, you have to include what you actually paid for it. And that's where that -1 comes in. Now, let's say the stock price is $25. Well, again, we can do a similar analysis. The profit is going to be 25, right? Minus, what are you going to buy it for? 25 minus 1. So your profit's actually going to be negative $1. Okay, and that's associated with, again, the price that you had paid for it. And let's say the stock price is $26. Well, your profit, quite simply, again, it's going to be 26. You can buy it for 25 because you're going to execute it. You paid $1 for it, so your profit is going to be 0. So we're typically not going to call this stock price such that a profit of 0 results as the break-even price. Okay. And the break-even price, again, is the price in which you have a profit of 0 and break even. Let's go through an example of a put option. Okay, so again, a put option gives you the right, but not the obligation, to sell a particular stock. So let's say you again have a stock XYZ. Okay. It expires the same dates. I'm not going to rewrite it, right? Let's say the exercise or strike price is $45. Okay. And the price of this put option is $3. So let's go through different types of scenarios, right? Let's say the stock price is $40. First of all, would you exercise this option? Well, of course, right? Because again, you get in a put option, let's just write put in this case, right? A put option gives you the right to sell it at 45. So of course you would sell it when the price is 40. So your profit would be essentially 45, right? Minus 40 minus the price you paid for it. And that's again going to be $2. Okay. And if the stock price is, I don't know, 45, same kind of math. It's going to be, you're going to sell it for 45 minus 45 minus 3 is equal to negative $3. Okay. And the question is, what is the break-even price? So let's say the stock price is 42, right? Well, what's your profit going to be? Well, you're going to sell it for 45, right? It's only worth 42, and you paid $3 for it. So your profit's going to be 0. And again, this stock price of $42 is going to be your break-even price for your put option. Okay. So again, what we're talking about, just more mathematical notation, is you're going to exercise the call option when it makes sense to do so. And when is it going to make sense to do so? When the stock price is bigger than what you can pay for it. It's a strike price. And in which case you're in the money and your profit's going to be ST minus X, right? Sorry, your payoff's going to be ST minus X because again, we didn't consider the premium or the call price you pay. And if the stock price is less than the strike price, you're simply just going to do nothing and let the option expire because you can simply get a better deal by buying it on the marketplace, in which case you're out of the money. And so written more compactly, your call option payoff is going to be the maximum of 0 and ST minus X. On the flip side, for the put option, if your strike price is bigger than ST, well, of course you're going to exercise it because you can sell it for X when the market price is S. And your payoff is going to be X minus ST, and you're in the money. And when the strike price is less than or equal to the market price, well, you're just going to let it expire because you can sell it out in the market and make more money, and you're going to be out of the money. So more compactly, your payoff for a put option at maturity is the maximum of 0 and X minus ST. Now, it's worth kind of walking through and drawing out the payoff structure, because a lot of the times when you're doing these kind of problems, there's a lot of numbers involved. And I think a visual really hones in on helps you understand on what we mean. So let's say you wanted to buy a call option. Let's try to see if we can understand the payoff figure. Okay, so if we have over here on the y-axis, the payoff. And over here, we're going to write the stock price X. And let's say the strike price here is X. Okay, so let's draw the payoffs. If you own a call option, well, first of all, if the stock price is below this, you're not going to do anything. You're just going to let it expire because you can get a better deal at the market. So this payoff is going to be 0 going up to the strike price. What happens when the stock price is above X? Well, we talked about it. You're going to execute it because you can buy it and lock it in at a particular price of X. So in other words, let's say the strike price here is, I don't know, 10. And now we're over here at, let's say, 12. Well, your profit, you're going to exercise it and you're going to make a profit of buying it at 10 when it's worth 12 of $2. So your payoff is going to look like this increasing line with a kink at the strike price X. Okay, so this is the payoff figure of buying a call option. Now, let's also talk about if you were to buy a put option. Okay, and sometimes people use the phrase long. It's the same idea. You're long the put option. Okay, so let's, again, put the stock price here, and let's put the payoffs here. Okay, let's say we had a strike price over here. Now, let's go over to the right side. We know that the stock price is a lot bigger than the strike price. We're simply just going to ignore the option, let it expire, and get a better price on the market. So we know that the payoff over here is going to be 0, which is going to let the option expire when you can get a better deal in the market. In other words, let's say this is 100 and the strike price is 90. Forget the option. Let's sell it for 100 on the market. Let's go to the extreme. Let's say the stock price is 0. What are you going to do? Of course, you're going to exercise the put option. You're going to sell it for 90 in this case, and you're going to make a profit of a payoff, of 90. And this is going to keep decreasing until you get to the strike price. Okay, because as the stock price increases, you're getting a worse and worse deal by selling it at 90. Okay, so this is the payoff structure of buying a call option and buying a put option. Now, let's put it on the flip side. Let's say that you were selling the call option. Okay, because for every buyer, there's got to be a seller. And so if you're selling a call option, you're selling the option for someone else to buy it at a particular price. Let's go through that logic. That might seem a little confusing because we're going to have to think about things in terms of opposites. Okay, let's say we have a strike price here. Now, if the stock price is below the strike price, what's going to end up happening is the option's not going to get executed, right? Because why would they buy the stock at a strike price of X when they can get a better deal on the market at X? So if you're selling a call option, your payoffs are going to be 0 leading up to the strike price. Okay. Now, what happens when the stock price is above the strike price? The stock price is above the strike price. Well, we know what happens. The option is going to get executed. And for every gain that this individual is going to have, that's a loss for the seller of the call option. Okay, so the payoff structure for selling a call option is pretty much unbounded, right? Because this can keep going on downwards. Let's say you're selling a put option. Let's talk about that logic for a bit. So over here we have our stock price, and over here we have our payoffs. Okay. So what's going to happen if the stock price is above the strike price? Well, we know what's going to happen. That person's not going to execute the put option because they can get a better deal in the market. So that payoff is going to be zero. Okay. And we know what happens when the stock price is below the strike price. That individual will absolutely exercise that put option. And for every gain, again, that this individual is experiencing is going to be a loss for this individual. Sorry, I should have drawn this a little bit better, but this is what the payoff for the put option is going to be. Okay. It's going to start from this negative number. It's going to increase all the way to zero and subsequently taper off at zero. And this is obviously much more neat than what I had drawn, but you get the same idea. Okay, so a call option payoff is going to look like this hockey stick. They're all going to look like hockey sticks almost, but they're going to be mirror images of each other. Right, so this is a reflection of this, and this is a reflection of that. So as I mentioned before, we did an example, remember, of stock XYZ. It's important to have a distinction between the payoff of the option and the net payoff, which I had actually called the profit before. They're the same thing, but the book likes to call it the net payoff, so we'll call it net payoff, but it's the profit. Okay, so if this is the payoff of buying and holding a call option, this is not the true profit because you had to pay a particular call price C, right? Before, I think the example is like $2 or $1. And what we're going to do is just simply shift down this payoff structure by the exact amount that you paid. And this would be the net payoff. So as an investor, this would be a much more informative payoff figure to look at to understand your profits and losses. Okay, and as an exercise, you should draw the net payoffs of all these different types of options. Okay, and again, the net payoffs are nothing more than shifting this downwards. And notice that when you sell a call option, you're receiving that payment, right? Because you're taking on that risk. So that's why you're getting bumped up by the amount that this is getting bumped down. Okay, and you're getting bumped up here when you're selling the put option as well. Okay, so let's say you want to do some speculation, right? If you're betting that the price will increase, well, you can buy a call option, right? Because by buying a call option, essentially you're betting on an increase in appreciation of the stock price. And if you're betting that the price will decrease, what you're going to do is you're actually going to buy a put option because you're capped or bound by this lower bound here. Okay, so these are kind of different strategies that you can have when you're thinking about whether or not you want to buy a call option or whether or not you want to buy a put option. Okay, so let's say that let's go through an example. Let's say the price of Apple stock at 11:17 a.m. on October 30th was 109.46. Okay, and this was essentially a 5% decline from the previous day. Okay, how did the call option with a strike price of 109 and maturity perform? Well, you'll notice that essentially this call option became less valuable, right? Why did it become less valuable? Well, because with a strike price of 109, that gives you the right to buy it at 109. But if the stock price decreased, well, the right to buy it at a cheaper price really doesn't get you that much of a good deal because the price went down significantly. So as a result, your call option became less valuable. Okay, because the price went down. So it's not as good of a deal. What happened about a put option? What about a put option? Well, the put option actually increased in price because now, since the price went down, again, a put option locked you in at a particular price. But when the stock price went down, this put option to sell it at this price became much more valuable because as this price goes down, your profits are essentially this difference, and the put option becomes more valuable. Okay, so that's kind of the intuition of why that would happen. And again, we looked more generally at this particular price. Again, it's important to look at the current stock price as well as the different strike prices. Okay, so the question now that I want to pose to you guys is consider the payoff diagrams. Okay, again, we started off by saying you can absolutely just buy the stock and have direct exposure. When the stock price goes up, you're happy. Stock price goes down, you're unhappy. You face the returns on a one-to-one basis in a linear fashion. Or you can also have exposure to this asset by buying a call option, in which case you're essentially bound by you're bound by your losses, right? You're experiencing an upside, but you're sort of capped by your downside. And the question is, why do you think this could potentially be riskier than buying the stock straight up? Well, let's consider two portfolios, okay? The stock portfolio one says that you can buy this, I think this is, let's just call this 65 just to make the math a little bit easier, okay? So let's say you have two options. You can buy a share of Apple at 109.65, or you can buy a call option on 25.5 shares of Apple at $4.30. Okay, so with a strike price of 109 and expiration of this. So the question is, why do you think this could potentially be riskier? Well, let's go through a number of scenarios that can happen. Okay, so both portfolios have the same cost basis of 109.40. Let's say this is 65, sorry. Okay. What are the holding period returns? So to get holding period returns, you need the next period payoff. So let's say this is potential stock prices. Okay, this is the stock portfolio scenario. This is the options scenario. Okay, let's kind of just get an idea of why this would happen. So let's say that the stock price is 107. Again, we talked about the strike price being 109. What would happen? What would be the value of your stock portfolio? It would simply be 107, right? If the stock is 107, your stock portfolio is worth 107. What's the value of your option? Well, the call option lets you buy it at 109. You wouldn't buy it because you wouldn't exercise it because it's cheaper at 107. So your call option's value is 0. The portfolio's value is 0. Let's say the stock price is now 108. What would be your stock portfolio? Very easy. It'd be 108, right? Because they work one-to-one. What would be the value of the call option? It'd be 0 again, because the strike price, let me just write it here just for 109. Okay. Let's say now the stock price is 109. Again, the stock portfolio is worth 109. Again, it's 0, right? Because you're essentially breaking even if we kind of just ignore the price for now. And let's say it's 110. What would be the value of stock portfolio? 110, again, because it is a stock. What would be the value of your option? Well, you can now execute it at 109. So your profits are going to be 110 minus 109. You bought 25.5 shares of it. So times 25.5. And that would be the value of your option. Okay, I actually don't have that number computed. Actually, no, well, it's just one. So try 25.5. Now, let's say that it's 115 now. And again, this is going to be 115. What you would do is you take 115 minus 109 times 25.5. You get 153. And we can do one more example. 130. And this would be 535.5. Okay. So what have we done? We've considered two hypothetical portfolios, one in which you bought the stock and one in which you bought the call option. And what you can see is that the call option strategy is much more volatile. Okay, so you're going to have much more periods in which you have 0, and you're going to have periods in which you can significantly outperform the stock portfolio. In other words, you're much more levered, right? So in the stock price scenario of 115, your option portfolio is worth 153. In 130, it's worth significantly more. So you're taking on much more leverage, and that's why buying a call option could potentially be a lot riskier because you are taking on that leverage. So this is a figure of the payoff structures. Okay, so you have the stock price moves 1-to-1. You have the call option that's going to have a return. Oh, sorry, now we're talking about returns. It's going to be negative 100, right? Because in this case, you lost all your money. So it's going to be negative 100. And over time, you're going to have much higher returns as given by these last two columns here. Okay, so in conclusion, options in isolations could potentially be riskier than stocks. And we just kind of talked about it, right? And this is the leverage aspect of it, that there are going to be periods in which you lose 100% of your money, as shown by the points in which you're out of the money, right? In which case you're not going to exercise your call option and your portfolio is going to be worth 0. And there's a lot more hedging strategies that we can talk about. As I mentioned before, one particular example comes to mind as a protective put option, right? So a protective put option is you buy the stock, right? So let's say you have the stock and it's currently valued at 110, and you're scared that it might go below 108 or 107 at a particular threshold. Simple strategy is to simply buy a protective put option, which locks in the price that you can sell it for. So you might want to get a put option with a strike price of 109 if you're scared of crossing the 109 threshold. So there's a lot more to understanding options, but in this video, I provided a nice overview of the different types of options. There's call options, there's put options. You can either be long the call option, in which case you own that option. You can be long the put option, in which case you own it. You can also be short, right? Because for every buyer, there's going to be a seller. And in which case, if you're selling a call option, you're going to be receiving that premium. And if you're selling the put option, you're also going to be receiving that premium as well. And in class, we'll be talking about much more exotic option strategies in which you mix and match calls and puts to create much more exotic payoff strategies. So I hope this was a good overview in helping you understand the basics of options. And in class, we'll be going through much more examples. And in the next pre-lecture video, I'll be talking about how to actually price these options, because we've been taking them as given, but there's much more details in trying to understand the price of a call option or the price of a put option. Thanks.